Okay, guys, let's start with a new chapter. Okay, the name of the chapter itself is actually company accounts, and this is the chapter number like 11, the CA foundation level, and unit 2. And see, this is a very good chapter, and from the here, both of everyone can expect at least 10 marks from here compulsorily. Okay, 10 marks you can easily expect from here. So this chapter is actually a very you can say a very interesting chapter with respect to the company's perspective and all that. With respect to this chapter, it is a very basic chapter, and in class 12 itself, okay, when we have to prepare the financial statement of the companies along with the company accounts, basic fundamentals, and some sort of chapters like redemption of debenture, issue of debentures, and issue of shares, forfeiture reissue. We have a lot of idea from there also, but today we are going to again learn it from a very basic level. Okay, see, like when we are going to discuss with respect to the business, like businesses, you can say we have different sort of businesses. Okay, like we have the proprietorship business, we have, you can say, partnership business, we have also companies like a private limited company or a public limited company. Maybe you can say the company who are listed, actually which are listed in the recognized stock exchanges. So you may find a different level of companies and different types of companies, okay, as per the Companies Act. But other than this, guys, we understand the fact is that how to prepare the final accounts of the sole proprietorship firm. We know that, sir, very well. So when a company is going to start, it may be like it's not a company. You can say it's an entity. Any entity is going to start. They need some basic fundamental before starting or incorporation. What are the fundamental that is actually requirement? The first point is that always number one is that they need have a place to do the business, and more of the important is that their ideas. So in case of proprietorship business, the idea are different. In case of partnership business, the idea little bit different. In case of companies, the ideas are fully different. Because in case of, let's take an example, suppose Mr. X is there. So if Mr. X wanted to start a business of glasses, glasses, it may be the powered glasses or it may be the sunglasses. Okay, they wanted to start the business. Maybe the sunglass, power glass are there. So when they wanted to start the business, they have to take the license from the respective authority, from the local authorities, and once they receive the license, it's called a trade license, you can start your business. That a sole proprietorship business may have with respect to a legal aspect. Only a trade license can start with the business. A saving account also can be pursued with respect to this. So it means a sole proprietorship concern can easily start its business without meeting any lot of hurdles in terms of legal aspect or in terms of the legalities. Okay, so they don't have any problem at all in terms of the legalities. But see, if I'm going to discuss about the partnership firm, we all know that minimum 2 persons are required to start a partnership firm, and partnership firm needs a agreement, obviously, because without the agreement the things with respect to the partners that they have in mind not will going to form. So it needs an agreement. Okay, and second thing is that partnership business can be registered one or cannot be a registered one. It means partnership firm may register themselves or may not register themselves. Otherwise, they can start. It's not a problem to them. They can simply take a trade license for doing the business and start them without doing any separate registration, because a partnership firm has to register themselves as per Partnership Act, as per the Indian Partnership Act 1932. Great. But see, if you not want to register it, you can also pursue, not a problem. Now these two is covered: sole proprietorship, partnership. Now come to the most important, which is called companies. Sir, companies as defined in section 2 clause 20 of the Companies Act 2013. We all know about what is a company, but the most important fact is that when a company is going to incorporate, first it has to decide how and what is the nature or through which it want to incorporate. Either it may be private company for which separate things are there. I am coming to the separate things, why I am using this word. And you can start with your business as a public company. So when you start your business as private or maybe public, certain things are there where you have to understand, you have to follow the legal aspects with respect to or in terms of the companies that need to be incorporated under the Companies Act 2013. So what are the important factors and what are the important documents that a company needs to start its business, sir? Sir, number one, when a company want to start its business, the first thing that it wants, that he has to first fill up all the documents that are very much related with respect to the company. It means, sir, see, the first thing is that the details about the objective of the company and the rights and the powers and the duties and the details of the promoters and the directors and the investors or the subscriber of the company. So they have to prepare memorandum and articles. So after preparing this, they have to fill it up with the ROC. What is called ROC, sir? Register of Companies. See, in India, any companies, if want to incorporate, they have to register themselves first with the MCA, Ministry of Corporate Affairs. They are mainly dealt with the companies related matter and the LLP, Limited Liability Partnership firms. They are dealt mainly with the companies and LLPs. It has been founded by the, it is actually basically a regulatory body which is like, you can say it comes under the ministry, okay, it comes under the Ministry of Finance. It comes under the Ministry of Finance, okay. And obviously the name is comes as, what is the name is that? Ministry of Corporate Affairs. It means, see, the name is Corporate Affairs, means the companies related affairs and the matters this particular ministry is going to take care. And actually this is also going to be headed by the chairperson, is called Nirmala Sitharaman currently, okay, who is the Minister of Finance also. So see, like, it's actually a separate body. You cannot say like it's a Ministry of Finance, it's a separate part, like it's a Ministry of Corporate Affairs, it typically comes. So here one person is there which is named actually called ROC, Registrar of Companies, okay. Except Maharashtra and except the Tamil Nadu, we all have one single register in every state. Other than this, like other facts are there. So these are separate thing with respect to the Companies Act, but the main thing is that a register is there with whom you have to submit all the documents specifically required for the purpose of registration of the company, means the incorporation related things are there. So once you submitted your name, obviously the company's name is very important, and it is justified by the MCA department like ROC, and all the documents that is submitted is duly verified and is fine and fitted to respect to your company, then ROC grant you a certificate of incorporation that is called INC 11. Certificate of incorporation that is called INC 11. In the form INC 11, they are going to give you. And where you have to register yourself with all these details. Now see, I have disclosed some of the parts with respect to companies, a very small part. When we start sole proprietorship business, I can start with 10 rupees. If I don't have, I can also start. If I have to start my partnership business, I can start with any amount that is required to be invested in the business. It may be zero or it may be anything. If I am going to be registered, then I have to give the amount to the department that how much capital I wanted to invest this partnership business, or If I am not going to register myself, then I can simply say, sir, I am going to start the business. That's all. I am not going to disclose the capital that I am going to invest. In case of company, guys, always remember, whenever you are going to start or incorporate your business, you have to first give the amount that you wanted to be as your share capital of your company. Means how much capital that you are going to have invested in your business in the form of shares in the company. So you have to first decide the capital and then you have to fill it up the form, because see, after filling up the form there is no option to give the capital, because it is a pre-decision you need to make before the incorporation. It's a matter with respect to pre-incorporation. Before going for the registration under the company's registration process, you need to just understand that you have some details regarding the capital. Means you have to give the details of the capital, that how much capital you wanted to be as a maximum amount of capital with respect to your company, which is actually called the authorized capital, which is actually called your authorized capital, that this amount of money that I am going to make it as a authorized capital. And along with that, you can give a details that this much is my issued capital also. It means the capital that you wanted to issue to the subscriber or to the investor, you can also fill it up. But the most important thing is that the capital you need to give the details, how much of capital you wanted to be start with your company and what is the maximum amount of capital that you can raise at this point of time. It is called the authorized capital. Okay, it may be equity share, it may be the preference shares, but you have to give the detailed scenario of this share capital portion to the MCA. It's a ROC. So now see, every business is going to be started, obviously needs some capital. If you don't say that I know doesn't need any capital, it's a wrong myth. Because even if I wanted to start my teaching, I need a pen and need a copy. Otherwise, I'm not going to start. It is not a matter that I have a camera or I have a laptop or not. It doesn't matter. The thing is matter that I need a pen and need a copy to start, so that I can easily show my detail, like show my actually what can I say, learning to all of my students through in the road also, in the roadside also. So it means you need a capital at least to start a business. It may be sole properties, it may be partnership, but it's my company. But see, as sole proprietorship and a partnership doesn't have so much of requirement or so much of disclosure that is required by the law, that as they don't have, they are not going to disclose everything. They're going to start anyway. But in case of the company, we have to understand in a very separate way what are the basic requirement and what are the minimum requirement that you need to do for starting a company. That is why the concept of the capital comes into the picture. That is the most important part with respect to the capital. So whenever a company is going to start its business or is wanted to start your business or incorporation, it needs to fill up the details of its capital. It's a share capital. Okay. And you people have heard about the name, is that what is share? So see, share is a very easy thing. Suppose you need capital, correct? You have in your pocket 5,000 rupees, but you wanted to invest in your business, let's say 10,000 rupees. So you have the 5,000 rupees in your pocket, but you need 10,000 rupees. So how is it possible for you to start your business? Because minimum requirement is 10,000. So either you may borrow or either you may take from anyone and give them some of the ownership of your company. It's quite possible, correct? So let's say, suppose I'm going to start my business and there is a person called XYZ. Okay, so XYZ ask me, I'm ready to give you 5,000 rupees, but I need some ownership of your company. So I'm going to tell you how I'm going to give you the ownership. Now let's discuss how can I give them the ownership. When these people is going to give me the money, so this is called the capital that I've received, but he needs ownership. He doesn't need any dividend, he doesn't need any interest, or he doesn't need any other things. Rather, he needs some ownership. So what a company can do, when a company raise its capital, it break its capital in a small pieces, guys. It breaks its capital in small pieces, you can say in small slices. So capital is what, sir? Capital is what? Capital is nothing but the small pieces, sorry, shares, small pieces of capital. You give them the ownership in the terms of piece of capital, because he invested 5,000 rupees and 5,000 rupees is your own money. So the amount of 5,000 is given in a piece of capital, in a small part. The piece is actually called giving the share. Share matlab what, sir? Share matlab I am transferring some portion that I wanted to earn to someone else. That is sharing. Because sharing is caring, like that. You just transfer some of your company's part to someone else. That is called ownership. So the amount, the capital they invested, for which you transfer some sort of piece to them, so that they get the ownership, and the piece is actually called shares, guys. The piece is actually called, sir, shares. So this is what important in terms of companies. So this is the shares that you need. So it is called the share capital, guys. It is called share capital. So when a company want to start its business, it needs share capital, and we very much understand what is a share. It's nothing but a small pieces of capital. It's a small pieces of capital, like slices. Great. So when a company is going to start its business, it needs capital. But how it's going to get the capital? There are a lot of provisions with respect to the issue of share to the capital, with respect to the capital. So this is actually comes under chapter 4, okay, of the Companies Act, guys. So when you people going through it, you are going to get a very detailed analysis in the CA intermediate level itself, okay, guys. But here we are going to understand what are the basic provisions are there and how we are going to deal with this. So this is the very basic part. First of all, the share capital. Now see what are the provisions are there. Okay. Number one, that is I wanted to discuss with you. If you tell me, sir, how many types of shares are there in the company? Sir, two types actually. One is a equity share capital. That is the first part. And another you can say, sir, it's a preference shares capital. It's a preference shares capital. See, in case of the equity shares capital, guys, we have like single types of capital. Like equity share means only equity. It means only the ownership. Equity means the ownership, okay. It means only one type of shares is there, but it may be different classes are there, like with respect to the face values, with respect to the grades, like differential rights, etc. Class may be different, but believe me, equity share capital is a single types that a company have with respect to equity only. It means ownership. Here, the shareholder have no right to ask for any dividend for the ownership in the company. They cannot ask it. Okay. So it's an ownership based capital. That is why it is called equity share capital. But in case of pref share capital, you have multiple things are there in case of the preference share capital. So let's discuss a little bit what are the different types of preference shares capital that we may understand. What are the things are there? See, in case of preference shares capital, we have multiple things. Number one, preferential right. Preferential right. Acha, one thing you can start. See here. First of all, you can write, please, it's easy. Redeemable, okay, redeemable pref shares, irredeemable pref shares. Irredeemable pref shares. Okay, redeemable, irredeemable. Convertible pref shares, non-convertible. Cumulative pref shares. Okay, cumulative is one of them. Acha, okay, I'm just going to off my camera so that it will have very picture clear. Cumulative, and other one is, sir, non-cumulative. I'm come to that with all the details with that so that you people get a very good idea on that. See, what I discussed right now, sir, preference shares. So these 6 types of preference shares are written, but we have more, 2 more. Okay, I'm going to just discuss it. Let's a little bit wait. I'm going to discuss. See, the first one is a redeemable pref share capital. Sir, what is a redeemable pref share capital? Redeemable pref share means the capital which can be reduced after certain period of time. After certain period of time, which can be repaid back to the investor from whom we raise the preference shares money. So it is called redeemable preference shares. It means redeemable means you can write repaid back. You can also write which will be repaid back. Sir, irredeemable means which cannot be repaid back. Okay, cannot be repaid back. But guys, believe me, okay, as per the new Companies Act 2013, no company can issue irredeemable pref share. Okay, so no company can issue these types of share. Okay, no company can issue these types of share under new Companies Act mainly. And the maximum time that a company can hold back the amount of the capital of the preference shares is maximum is at 20 years. Okay, 20 years. And in case of the infrastructure company who are engaged in the road construction, dam construction, they can repay the money of the preference shares within 30 years. Okay guys, so maximum amount of time that a company can repay back its preference shares holder money, it's 20 years. Okay, maximum time is how much, sir? For the repaid back, 20 years. But sir, in case of infrastructure company like dams, roads, bridges, okay, but for infrastructure company, it will be 30 years. It will be 30 years. Okay, so this is what the redeemable and irredeemable. Redeemable means which can be repaid back, irredeemable means which cannot be repaid back, but right now it's not there actually. Now convertible. Convertible means what, sir? Which can be easily converted into equity share of the company. See, it means conversion. It means conversion can be converted in equity shares, and it is cannot be converted, guys. Clear? Cannot be converted. So it can be easily converted and it cannot be converted at all. Now let's discuss about the thing. So what is this called actually? Cumulative. So with respect to the cumulative, I can say, see, in case of cumulative means suppose a company is unable to repay the preference shares dividend to the preference shares holder in any year. Suppose a company is unable to repay the preference share dividend to the preference shareholders in any year. Their dividend will be cumulated. their dividend will be added and it will be carried forward to the next financial year, so that the last year dividend and this particular current year dividend can be added and then repaid back to the preference shareholders. It means cumulation means addition or grossing up of the dividend that is pending actually. It is called cumulative preference shares capital. Okay. When dividend can be accumulated and repaid within a period of period of 24 months. Now, why write so? I am going to explain it. See, as per the new Companies Act 2013, as per the new Companies Act 2013, every company, okay, who has issued any preference shares, okay, every company who has issued preference shares, they have to repay the preference shares dividend, okay, in a yearly basis. And if any company unable to repay it, it can take a time of 24 months maximum to repay the same. Okay, because if in future 24 months if expire and unable to repay it, then it can be converted. Then it can be converted. Then sir, it can be converted. It's very important. Okay. So if a company is unable to repay the dividend and which is still outstanding for next 24 months, okay, then it can be converted. Okay, it can be converted into equity shares. It can be converted into equity shares. That's what we need to understand here. Okay. So if you people are, suppose a company called XYZ, they are paying preference dividend 10 lakh rupees each and every year. Okay. So what happens if the company is unable to repay the dividend, okay, a period of let's say for let's say 23 months, then no problem. But you should remember the dividend which is pending for last 23 months, you have to pay within a period of 24 months. It means 1/1/22. You can get a maximum time of 31st December 23 to repay the dividend. If it is due in this particular period for due for the this particular period, so you have to repay it within a period of 24 months. Let's say it is due based on the 31st 12 21 December. Okay, 31st December 21. 31st December 21 is the due date, and you still not paid this dividend, then it becomes a problem. So what will be going to happen? क्या होगा? Ranush, what will going to happen? Their shares will be converted into the no, not dividend. If suppose the company is unable to repay the dividend for 24 months and is still unpaid, then it can be converted into the stocks. It can be converted into the stocks, means the equity shares. Okay, got it? It can be converted into the equity shares. It means, see, if you are not paying my money, then I am going to take your ownership, like that. So if the dividend is unpaid for 24 months with respect to any preference shareholder, then the preference shares will be converted into the equity shares. They will get the ownership of that. That's very important. Chali. Now let's move on. Non-cumulative means, so see guys, these particular preference shares, the you can say investors are not very interested on that. Because why? Non-cumulative means the preference shareholders are not going to get their dividend if company is unable to repay the dividend for any particular year. But in case of cumulative, their dividend is accumulated each and every year. Suppose in this case, if company unable to repay the dividend for the year 2023, then it's obviously sir 2024 is going on. So sir, bhul jao, forget this, please forget this. you are not going to get the dividend for the period of 2023, because the new year started, the new year dividend is going to come to you. The old dividend which has failed by the company to repay is failed, you are not going to receive it. It is called non-cumulative, and believe me, this is very like irrelevant types of preference shares, and pref shareholders are not so interested in this, because if you are not going to get your right, then why are you going to invest? Everyone needs the money. If the money is not come in time, so there is no logic to invest in this. And other than these 6, we have, sir, participating pref shares and non-participating pref shares. Here I can draw like this. यहाँ से मैं ड्रॉ कर लेता हूँ एक बार. Okay, you can write, I just make a 2 part here. Okay, one is that, sir, participating and non-participating. These are 2 things. What is called the participating, sir? Participating means the shares, okay, which can participate in the surplus profit of the company. It means, sir, these shareholders, these PEP shareholders can take participation in the profit. Please write this one. These PEP shareholders can take participation in the profit or surplus of the company. That's why their name is participating, because they can take the participation. Why their name become participating? Because they can take the participation in the profit or surplus of the company. That's why their name become participating. And so why it is non-participating? It means that they cannot take the participation. Okay. They can only get fixed dividend. They have no right in any profit of the company. Got it, guys? Done. So they have no right in any profit of the company at all. So these are the 8 different types of preference shares that we discuss. Okay. So this is what, sir? Equity share capital done. Pref share capital we have, sir, redeemable, irredeemable, convertible, non-convertible, cumulative, non-cumulative, sir, participating and non-participating. So these are the different types of capital like shares we have in the company. Okay. Now see, little bit more discussion we need to make with respect to the shares, and then we are going to move to it. Okay. See guys, चलिए अब discuss करते little bit. So the first thing is that when a company is going to start its business or going to incorporate it, what it needs, sir? Capital. क्या चाहिए sir? Capital चाहिए मुझे. Correct. So if we need the capital, so the most important thing is that how we are going to get the capital, sir. That's the first thing. If we wanted to start the business, how we are going to get the capital? Correct. So see, in case of proprietorship firm, the different ways are there. In case of partnership firm, 2 partners invested the capital. They can invest more or they can invest less. Suppose in case of a proprietorship firm, okay, suppose I am the proprietor, I am the owner. I am the proprietor of the proprietorship firm. So I can invest 10 rupees, and if wants more, then I can also give 10 rupees more. So it's flexible. You can change its capital based on this. In case of partnership firm, sir, 2 partners together jointly invest 10,000. They started their business, and if the business requires more capital, again the partners will invest in the business. It's fine. But sir, in case of a company has to follow a certain rules and the laws with respect to the Companies Act for taking the capitals from the shareholders, for raising the capitals from the shareholders. It cannot take the capital whenever it wants. If company wants, see my capital getting lower due to some of the other investment or maybe the loss of the business, I need more capital. No sir, it's not possible. You have to raise a special resolution. You have to raise or pass a special resolution to get the capital, and also you have to get the approval of the shareholder in the meeting. You can get it. So it means a lot of things and a lot of laws and rules and circulars are there, regulations through which you can invest the capital into the business. So sir, what is the first thing? Sir, the very first thing is that suppose if I want to raise the capital, so a company can raise its capital in different part of the face value. So a company can raise its capital in different parts of the face value. Guys, everyone please write. Hashmita, Kruti, Ranush, Vansika, everyone please write this one. So a company can raise its capital in different parts of its face value. And face value means what, sir? Face value means when a company want to start its business, okay, the total number of total amount of share capital that it want to raise divided by the number of shares that it wanted to raise. Let's say company want to raise 1 lakh rupees of capital, and it wanted to give like 10,000 shares. Okay, it wanted to make a piece of 10,000 shares. So your face value for each share is 10 rupees. It means the value with respect to your shares, that is a nominal value. The minimum value that company fixed is that with respect to the share is 10 rupees. Total amount of share capital divided by the number of shares that company raised or number of shares outstanding. That's it. So it's called a face value. So when a company want to raise, see guys, a company can start its business when it going to receive money from the public. I'm repeating guys, if a company want to start its business, it first requires some money from the public. So what the company will do? Company will make an offer to the public for getting the application from the public for raising the capital. So company will offer to the public and raising the capital from the public and asking for the application to be deposited. So the first thing that the capital the company can raise through its capital is that application. So the first thing is called, sir, application. So every company needs first application money. So they can understand how much investors, how many investors are interested to invest in their company. How many investors are interested to invest in our company. That is the first and very foremost important requirement. Clear है guys? ये सबसे बढ़िया important है. ठीक है. After this, sir, when you receive the application money, then you are going to start to allot the shares. It means, sir, suppose I am issued 10,000 shares. So if I receive 10,000 application, it's very good, sir. 100% application you receive, and then I have to discharge or I have to allot 10,000 shares to the demat account of the subscriber or the investor. Because today in this point of time, in the AI time, we are not going to issue any handwritten or any share certificate to the shareholders. That we are done in a very few years ago, like 2006-7 times. Okay, you see the movie Guru, you see the scam Harshad Mehta, that point of time, the shares has been dealt with respect to the paper and pen mode. Okay, like that. But right now, today it's not possible. Everything is on the online basis, everything on the trading basis, like trading digitized basis. So there is an account called a dematerialized account in which your shares are transmitted to your depositories, CDSL and NSDL. That's all. I'm not going to that part. So see, when the shares are going to be discharged or allot the shareholders, okay, it is called allotment time. And that point of time, when you allot them, you are going to ask them for the allotment money. I received, sir, application and I wanted to make an allotment to the public. So I asked them, please share the allotment money or give the allotment money. We are going to allot him. Okay, we are going to allot him. or allot them. So sir, allotment money is that when you are going to allot the shares of our company to the public who has made application for the subscription of the shares, at that point of time we are going to ask them for allotment money. So it is called, sir, allotment money is the second part. Third part is that, sir, then after allotting them the shares and receiving the allotted money, we are going to get the first call money. We are going to get the first call money. So we call them, hello sir, can you give your payment, balance payment to that? Yes, why not? So the first call we made to the subscriber or the investor or the shareholder, they are going to pay the money part by part. And then last one is that second and final call. So any amount left, okay, like from the face value, any remaining portion of the face value left, we are going to call up at the time of second and final call money. At the time of second and final call money. So these are the mainly the different parts of the face value that we are going to raise. These are the different part of the face value that we are going to raise. 1 minute guys, huh? Let's see. So these are the different, okay, these are the different parts of the face value that we are going to receive at the different times, okay. So it will take us some point of time. Let's say once you receive the application money, within a period of 1 month, you have to make the allotment to the subscriber of the company, okay. So see, these different parts of face value that you are going to get from the investor, it's called, sir, installments. It's called installment money, and it's a nothing but the nominal value of the shares. It's a nominal value of the share, and these are all called installment money. See how it is different from a proprietorship business and a partnership business. It's totally different. It's not matching at all. It's a pure different thing, okay, no match at all. So done is, sir. So a company can raise its capital in different parts of the face value: application money, allotment money, first call money, and second and final call money is the installment money. Okay guys, clear? Now let's move on. After this, sir, if I wanted to discuss number one, suppose a company, let's say, doing a business since 20 years, but it's doing its business by own. Let's say, let's take an example. But company, if wanted to come with respect to the taking the amount from the different persons, okay, because see, suppose a company doing a business is 20 years as a, let's say, partnership firm. Now you wanted to convert it into the company. So obviously, sir, it has to raise the capital. So it's going to get the capital from the shareholders. It's going to get the capital from the shareholder, and it has to first give the details of the company. First you need to incorporate, and it has to decide how much capital it wanted to be in its company, and then it can raise its share capital from the market. It can raise share capital from the public itself. And a company, if let's say it's a very old company, so a company can raise its share capital at par. Three concepts are at premium or at discount. Three parts are there, okay? Let's understand with an example. Let's suppose take the company's face value as decided rupees 10. So now if company wanted to raise the shares capital at a same value, that is rupees 10, then it is called, sir, at par. It is called, sir, at par, means the whatever the nominal value of the share it has, it is raised only to that point. Whatever the value of the share it is, it will raise to that only. It means that 10 rupees. जो है वो बराबर रेस करेगा एक ही दिन, ठीक है? After this, sir, suppose it has very good amount of goodwill. It means they have like you heard about the name of, like, let's say Boro Plus, where Amitabh Bachchan makes the ad in the TVs, televisions. So these type, Vaseline, Nivea, so these types of companies having, let's say they are come to incorporate a company. So they have a very much goodwill with respect to them. So see, they wanted to raise the capital and they ask more money from the investor, rather 10 rupees. So say they are going to ask the public for 12 rupees. This 2 rupees extra. So if share issued, okay, over and above the face value, if the share issues over and above face value, it is called, sir, it is called at premium, means we have issued your share at a premium, okay. So the 2 rupees is your premium. So how much, sir? 2 rupees is your premium, because you have raised the share over and above the issue price or the face value. It's done, sir. Over the face value, not issue price, sorry, over the face value. See the next thing. It's at discount. Guys, earlier there is a provision, okay, that you can issue share at a discount. But the things that changed right now, as per the Companies Act 2013, if I am not going to like mention the section, see, मैं mention कर दे, section भी mention कर देता हूँ. As per section 53, okay, of the Companies Act, 1 minute, I'm just offing, close out my video. Companies Act 2013, a company cannot issue share at discount. Cannot issue share at discount other than only sweat equity shares. It's a different shares. Sweat equity shares are different types of share, okay. We're not going to like get this point. Sweat equity shares, a company can raise sweat equity shares, okay, maximum. So see, what is this actually, guys? Let's understand this. Chale. Suppose a company want to issue its share 9 rupees. So what negative impact that shareholders has? Suppose your company's minimum value is 10 rupees. Let's say face value is a minimum value. So if you give them any discount, it means public will think that there is a problem with respect to your company, because you are not coming to the public, okay, before this issue. It's your first time. So when you come with the discount, many person like the investors can think that some problem the company has, because see, everyone not going to take it positively. Some person is going to take it a negative way. So obviously when company comes with the issue at discount, then people can think that there is an issue for which company is getting negative responses. Company is getting negative responses. So what the point in this? So that only as per the Companies Act, new Companies Act, and after a certain period of time, okay, the company lawmaker made the decision that, sir, we cannot issue share at discount. We can issue share at par or premium, not in discount. But in respect of sweat equity share, which is given to the director of the company or any employee of the company, mainly the director of the company, for their using their intellectual property right. It's a separate thing. I'm not going to that point. Just get an idea. Sweat equity shares given to the director of the company for using their intellectual property right. That's all. So other than sweat equity share, company cannot issue share at discount. It's a minimum basic requirement that company need to follow at the time of issue of shares. At the time of issue of shares. That's a minimum basic requirement. Complete, sir. So, sir, company can issue share at premium or at par. I'm not going to discuss that at discount. We have completed. Okay? So, this is a very basic part. So, see, this is what we have understand. Now, I'm going to get into the main part and going to in the part of journals. Okay. See, accounting part. Mainly, I'm going to close to the accounting part mainly. Chaliye. Now, accounting for issue of shares. Guys, when a business started with cash, okay, in case of a partnership business, or you can say in case of a sole proprietorship concern, what journal entry made, sir? It's very easy, sir. When you started business with cash or any asset, then, sir, the asset or the cash will be debited and capital will be credited. That is a basic journal entry that we follow. Correct. So the basic journal entry is that, sir, in case of any sole proprietorship business or the partnership business even itself, sir, basically you can follow, sir, bank or cash or asset account debit to, sir, capital account. But in our case, in case of companies, the accounting aspect is little bit different. See, concept is not going to be different. Everything related to the capital only. Everything related to the capital only. Everything related to the capital only. But the thing is that the accounting entries and the accounting aspect are totally different. No match, you can say. It's a totally different accounting that we need to follow. So, sir, we have discussed that application money, allotment money, application money, allotment money, first call money, final call money. You see, it is based on the installment. So when we are going to issue the shares, the first thing that we are going to receive is the application money. Remember this. The first thing that we are going to get or issue is that application money. Okay. So now, guys, क्या होता है? When you people are going to give the examination in the CA foundation or CA's executive level, they need to fill up a form for which you need to pay application fees or exam fees, you can say. Obviously, this is called application money. And after 1-2 months, you are going to eligible to sit in the examination. If you don't fill up the form, you are not eligible to sit in the examination. That is a basic requirement. Like the same way, if company want to issue shares to the public, the first thing is that company has to get the application money from the investors or the subscriber. So the, sir, first journal entry will be company has to receive this, na? Then company issue the shares. So the first thing is that, sir, write down the journal entry. Okay. When application money received. When application money received. Sir, the first journal entry is that, guys, see, we receive the money. We receive the money. It means bank account debit. Okay. Bank account debit. We receive it, and with respect to which we are receiving the money, it is based on the application money. We are receiving based on the application money. So you can write here equity share application. It is an equity share application. Okay. You can write here equity shares application. So mark it here. It's an equity share application. And we have to also give the narration, because on the narrations, we have a lot of numbers are there. Huh? Guys, please remember, narration is very, very important. Don't forget ever to give the narration in the examination hall. It's very painful if you don't give the narration. Write down narration being application money on dot 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 number of shares you can write. On number of shares you need to write here number of shares at rupees this per shares at rupees whatever the amount it is you can write at rupees face value you can write, let's say 10. You can write face value per share, you let's say 10. Okay, so no sorry, just cut it down. Let's say you receive rupees 2 because 10 is the face value. Okay, 10 अच्छा पूरा काट दो इसको, नीचे लिखो यहाँ पे rupees 2 per share. So if I take the example of that, I just write it down here, so it will be very easy for you. So suppose our face value is how much, sir? 10 rupees. Face value is 10 rupees. Face value is what, sir? 10 rupees. Now see here, being application money, okay, on number of shares at rupees 2 per share. Let's say face value is 10. Now you just make a bifurcation on that. You can say application money is how much, sir? Rupees 2. Let's say allotment money, let's say for example, sir, 3. Okay, and let's take an example. And you can write here, let's say first call and final call, okay, 2.5 each. Okay, 2.5 each. This is what we need to write. So that's why I written here 2 per share. After this, sir, these were the first journal entry. Now, when you receive the application money, obviously, guys, we need to transfer the application money to the share capital account. We need to transfer it to the share capital account. Okay, application money to share capital. So equity share application. अरे यार, application होगा हाँ. We are transferring the application money, so application money is created in the first entry, so it will be debited. So equity share application money account debit to equity share capital account. But here we just need to give an extra narration, okay, because this is a special narration because it's a capital entry. It's a capital transfer entry, so we need to give a extra little bit of things with respect to this. So being amount of application transferred to, being amount of application transferred to share capital. Okay, number of shares and amount per share with respect to application you can mention. Okay, as per, that is what important, board, okay, resolution number dated. That is what the special one. That is what the special one that we need to discuss. Okay, that is the very first journal entry we made. That is the second journal entry we made. So our first journal entry when application money received, and it is a transfer of application money to the capital account. Acha, I just forgot the name of the heading. Okay, you can write here when application money transferred to the capital. That is what important. When application money transferred to capital. Okay, done. Acha, third one, sir. See, after application, we have to allot the share to the shareholders. So what will be the general entry, sir? See, the things will going to get changed. It is called application money we receive. Now, here we are going to do the allotment first and then we are going to receive the money. Okay. So when allotment money due, it's a entry for allotment money due. So the general entry will be, sir, see, equity shares allotment account debit to equity share capital account, guys. And most important, if you raise equity shares with securities premium, then the journal entry should be added with securities premium also, guys. I am repeating, guys. Suppose you issue shares at premium. When you issue shares at premium, okay, the allotment money mainly consists of securities premium. Mainly, it may be consist in application money. You can raise premium or take premium from the subscriber of the shares at the time of application. But 90% cases at the time of allotment, securities premium are raised. So that's why he made the securities premium entry at the time of allotment money due. As it's a capital profit, so we are going to credit to the securities premium because we are taking extra money. We are taking the extra money for what purpose? We are taking the extra money for the purpose of securities, for the purpose of capital nature, which is actually the capital nature, because we are raising the capital and we take the extra money, so it's a securities premium. So here you can write it is in the nature of capital profit. Okay, so it is a capital profit type nature. It is not a profit, you can say it's a gain simply, because you are taking the extra only. Okay, profit is coming from the business mainly and gains also coming, but gains mainly coming from the other ways. Okay, so it's a gain, you are raising some gain or profit. So this is what the second journal entry. So I am doing also the narration, guys. Narration एक बार लिख लो, guys. Narration on this, because there is no such like space is there. I am going to make the narration here. You can write the narration. Okay, being the allotment money due, being the allotment money due. Okay, being the allotment money due, you can write being the allotment money due, and remember being the allotment money due. Okay, and due along with लिखो along with premium. Obviously premium is there, along with premium, and most important, and मान लिखो as per board resolution number dated. ठीक है guys, that is done. Now after this we have fourth entry, receive of allotment money. So bank account debit to equity share. Equity means EC, yeah, that's why I made shortcut. EC ne EQ, sorry, equity share allotment. Being being allotment money received. Completed, sir. Okay, being allotment money received. Now after this, sir, we have first call and final call. Okay, first call and final call. So you can write the same way. First call money due. So here always remember, after application everything, okay, after application the other installments, always we due the entry first and receive the amount later. So here we can write equity share first call account debit to equity shares capital account. It's done, sir. Being first call money due. 6. Then I am going to receive the money. Sir, bank account debit. We expect that why the bank account is debited, because we receive the money, so what comes in debit, so that's why it is debited. Bank account debit to equity share first call. Being first call money due as per board resolution number dated, and these entities belong to the first call money received. So bank to equity share first call. Okay, done. Being first call money received. Being first call money received. 7, sir. Final call due as per board resolution number. Same way, the same journal entry I am doing, just installment name has been changed. Okay, it is a very basic part. We have to follow this, otherwise we are going to get some trouble while doing, because this portion is basically of journals menu. Okay, final call is done, sir. And then final call money received. So here bank account debit to equity share final call. Done, sir. So here we have completed all the journal entries, but other than this multiple parts are there, just we are going to learn, but this is the very basic part that we have already covered. Final call due and then final call money received we have completed. Okay, so here you can write being final call money received. You can write being final call money received. Done, sir. Completed. Now see, this is the very basic part what we have learned here. Okay, other than this we have multiple things to be learned and multiple things are to be there. Just it's a very basic thing, so we just make a understanding of that point. It's clear, sir. It's very clear. Okay, now it's done, sir. So it's a very basic. Let's take an example and make it a solution of that, and let's solve it. Okay, let's take some example. Guys, please write it down, one example with me. Write it down, one example, guys. Fata. Let's do one example with respect to this. आप लोगों को सब देख लिया? You people have see how I made the journal entries here. There are total you can say 8 journal entries I have made. They all are very basic journal entries related to the issue of shares. And once we understand it with an example, then we are going to move to further things. Okay. I think we have cleared it. Okay. With respect to all the journals. Okay. Let's note it down. Take on example, guys. Let's note it down. On 1st April, लिखो, on 1st April 2023, Syngchen Limited issued 43,000 shares of rupees 100 each. Payable as follows: rupees 20 on application, rupees 30 on allotment, rupees 25 on first call, date is 1/10/23, and rupees 25 on second call, date 1/2/24. Okay, so all the application money was received and shares were duly issued, or you can say allotted, to the subscriber. Okay, what is written, sir? All the application money was received and shares were duly issued and allotted to the subscriber. It's clear, sir. Now just go through these sums once. On 1st April 23, Syngchen Limited issued 43,000 shares of rupees 100 each. Payable as follows: 20 on application, 30 on allotment, 25 on first call, date 1/10/23, 25 on second call, date 1/2/24. All the application money was received and shares were duly issued, allotted to the subscriber. Shares were duly issued, allotted to the subscriber. It's very easy, sir. It's clear cut. Now I just need to make the journal entries here. Okay, I just need to prepare it. So how we are going to prepare it? Let's discuss this. Let's take some format here. फटाफट करते हैं. Let's understand this. I make a format of how to prepare. See, it's a very basic part. It's a journal entry basically we are need to make because it's a very starting part of raising the capital. So it's all are based on the journal mainly. Okay. So we are doing it based on journal itself. We need to make total 4 columns. Okay. Out of the particulars one. Date, ledger folio, amount. You can write it. Date, particulars guys, ledger folio, rupees and rupees. You can say debit and you can say credit. It's a solution. Huh? Let's solve it. You can write sir books of uh, whose books we are preparing guys? Sinchen. So books of Sinchen Limited. Books of Sinchen Limited. So we are doing mainly so journal entry. We are doing mainly journal entries. Okay. So you can write here journal entries. And guys, I'm suggesting you one thing. Okay. Always mention the things for which you are doing journal entries. So always mention the event for which you are doing the journal entry. So we are doing for which purpose? You are doing it for the purpose of issue of shares. So mention it for issue of shares. Okay, done sir. For issue of shares we are doing. So you can just mention it for issue of shares. Now let's say number 1. Here guys see total 43,000 shares of rupees 100 each payable as follows. So the date is 1st April 23. So I just make one date here. You can write 1/8/23. So it's really easy. So on very 1st April, Sinchen issued 43,000 shares of 100 each payable as follows. So 20 on application, 30, 25, 25. All the application money was received and shares were duly allotted to the subscriber. So can I write here sir the first entry when he received the application money on 1/4/23. Sir bank account debit to equity share application account. I can easily write sir how much 43,000 into 20. So you can write 43,000 into 20. So if I am going to solve this 43,000 into 20 is that sir 8,60,000. 8,60,000. Okay. So it's at 8,60,000 is the first entry. So you can write here being application money received on 43,000 shares at the rate 20 each. Done sir, completed. So on the same day, I expecting that you also transfer the application money to the capital, equity share capital. So you can write equity share application debit to equity share capital account sir. How much sir? 8,60,000. Done. Being application money transferred to share capital as per board resolution number dated. Third sir, the journal will be sir based on allotment. So allotment was due on 1/8/23. So we need to make a journal based on 1/8/23. So you can write here sir first due entry guys in the case of allotment from allotment onwards everyone is due entry first. Okay, equity share allotment account debit to equity share capital account, it is nothing but 30 rupees. So 43,000 in 30 rupees. 43,000 into 30 rupees, you can get 12,90,000. Being allotment money due on 43,000 shares at the rate 30 each as per board resolution number dated. Fourth, equity share allotment account debit to equity share capital. That is what the entry here. Now we are receiving the money with respect to this on the same date. Bank account debit. Done, sir. Being allotment money received on 43,000 shares, okay, at the rate 30 each. It's also done, sir. Sir, after this, we have 25 rupees on first call, 25 on first call. Sorry, second call. So you can say second is a final call. So 110 and 1 February, okay. So on 110/23, we have a journal entry of, again due entry, equity share, first call account debit to equity share capital account, 25 into 25 into so guys, it has completed till the first call. Now let's move. Acha, again we need to make some format here. Okay. See, the last entry that we have only with respect to the final call or second call, you can say. So I have the journal entry number 7 on 1/2/24. In the next financial, it's moved into the like calendar year, change to the calendar year, but we are in the same financial year. So equity shares, second and final call account debit to equity shares, capital account. Okay, equity share second and final call account debit to equity share capital account. So 43,000 into 25, 10 lakh 75,000, 10 lakh 75,000 being share capital for second call raised on 43,000 shares at the rate 25 each as per board resolution number ... date. Last one, huh? Receiving the money on the same date, bank account debit being money on second final call duly received on 43,000 shares. Completed, sir. So this is what the basic part of the issue of shares we completed with very basic journals. See, it's a very basic journals. Okay, it is not in any advanced level journals that we discuss. Okay, it's a very basic journal and very basic part, so that your things are going to get memorized whatever you have learned in the class 12. So you have completed, sir, this portion. Now we are going to move little bit advanced and let's understand thoroughly other part of this. Okay. See, the first thing that we are going to learn is that what is called the under subscription and what is called the over subscription, that we are going to learn right now. Okay. See, the first thing is that what we have to understand is called the subscription. Huh? The thing is that we are going to learn first is subscription status. Okay, that is what we are going to learn, subscription status. The first thing is that subscription status that we are going to learn. Subscription status, you can divide them in three parts. One is called, sir, under subscription. One is called, sir, full subscription, and another is called, sir, over subscription. So these are three parts that we need to discuss. Okay, one is called, sir, under subscription, another is called, sir, full subscription, and another is called, sir, over subscription. There are three parts: under, full, and over subscription. See, the three parts you need to understand. We've taken a small example. Example 1. Suppose 10,000 shares were issued. Suppose 10,000 shares were issued. Okay. When 10,000 shares were issued and first scenario, all the shares were subscribed. If all the shares were subscribed, okay, when the 10,000 shares were issued, it is called full subscription. It is called full subscription, means out of 10,000, 10,000 shares has been subscribed by the public. Out of 10,000, 10,000 shares has been subscribed by the public. It is called fully subscribed. It is called, sir, fully subscribed. And that is what the name here is mentioned, full subscription. Okay, full subscription. It is called full subscription. Clear, guys? Done? Sorry, guys. Sorry. Okay. Now, let's take the case 2. Case 2 mentions, sir, out of total 10,000 shares were issued, 9,000 shares were subscribed. It means only 9,000 persons or 9,000 publics are subscribed your share. They are interested. Other 1,000 not so interested. It means your 1,000 shares were unsubscribed. It is not subscribed. So only 9,000 shares were subscribed. So it is called under subscription. It is called under, means what you have issued for subscription, the received application is less than that. It is called under subscription. When application received is less than issued. Correct. When application received is less than issued, whatever the application you made, you receive the less response from the public. So it's called a under subscription. Now in case of the third, sir, in case of the third, it is quite possible that you receive 20,000 application. See what differences it has happened. See, guys, you have raised, okay, you have raised for 10,000 shares, or you are asking to public for getting 10,000 shares, okay, for raising 10,000 shares, but actually public making you the super response, okay, bumper response jisko bolte hain, or 20,000. So it means you receive 10,000 more or extra application over and above your normal issue. So it is called over subscription, means more or over and above the subscription you issued. So it is called over and above the normal issue. Whatever the normal issue made, you have the over subscription. Now let's understand with respect to these three. These are the example we understand, and now how you are doing accounting with respect to all of these, that's the main question. So guys, first of all thing is that where we are going to understand the full subscription. Full subscription is for 10,000 issued, 10,000 received for application. This is what the sums we have completed here. Just these sums. Where we have issued 43,000 shares and all the application money was received. It is called full subscription, means all the shares were subscribed. Okay. So it is the case of full subscription. Now what is the case of under subscription? Under subscription we just understand where the subscription is less than, where the subscription is less than the amount that you the number of shares that you wanted to raise, the number of shares that you wanted to raise. Now see, with respect to the under subscription, we have just need to understand some provision here. Okay, you can please write some provision, please. Provision for under subscription. Provision for under subscription. What are the provision is there, sir? Can you please write, make a write? As per section 39 of the Companies Act 2013, the application money, okay, the application money must be at least 5% of the face value of share. What does it mean, sir? See, it is a very interesting part and very important respect to the Companies Act 2013. When you set your application money installment, you need to remember it should have to be at least 5% of the face value. It means if your face value is 10, the application money should have to be 50 paise at least. You can set a higher price or higher application money, but you cannot set below 5% of the face value. That is most important. So with respect to each and every shares, the application money should have to be minimum of 5% of the face value. It should be more than that, but shouldn't be lower than the 5% of the face value. That is what the first point. Number 2. A public limited company cannot make allotment of shares unless the minimum subscription unless the minimum subscription amount is received. Sir, what it is actually meant for? It means, sir, a public limited company cannot make allotment of shares unless the minimum subscription amount is received. So until and unless you receive a minimum subscription amount, you cannot raise the issue. You have to take it back, because there are certain criteria, that is a minimum criteria with respect to which you have to raise the share. There is a minimum criteria has been mentioned as per the act. So what is the minimum criteria? That is what is the amount of minimum application money that you need to receive to allot the shares. Okay, to allot the shares. Remember, minimum, or you can say at least 90% of the subscription, 90% of the subscription against 90% of the subscription against the entire issue before making allotment of any share. Or debentures, you can also write, as per SEBI guidelines. You can make a addition on that here. Okay, a minimum at least company must receive. You can make here and it is not. Okay, so company must receive. So what is the provision, sir? See what is written. Company must receive at least 90% of the subscription against the entire issue before making allotment of any shares or debentures as per SEBI guidelines. As per SEBI guidelines. See what is meant? Again I am repeating. As per SEBI guidelines, you can say company must receive 90% of the subscription. Okay. 90% receive 90% subscription against the entire issue before making allotment of any shares or debentures. So see, it means what, sir? See, if guys, if company issue 10,000 shares, if company issue 10,000 shares, company has to receive minimum 9,000 shares application. I'm repeating, guys, if company issue 10,000 shares for the subscription, at least 9,000 applications should have been deposited in the company's account. It means 90% of the public should have to subscribe them. Otherwise, company have to withdraw the issue. Otherwise, company have to withdraw the issue. So minimum 90% of the subscription should have to be received before issue any share to the public. It's a very important part. And your application money should not be less than 5% of the face value. Should not be less than 5% of the face value. And these 90% subscription, it means minimum 9,000 shares subscription should have to be received from the public if you issue 10,000 shares. So these three provision you guys need to remember along whenever you are going to solve the question. This will help you a lot to check. Okay, this is a minimum provision that we need to follow always. That is what done. So with respect to the under subscription, these three are very much relevant. It is quite possible that you receive 9,500. It's okay, sir, fine. 10,000 issued, 9,500, it's fine. But it cannot be less than 9,000. Then you have to withdraw the whole issue. Okay. Now let's move to the over subscription part. What is called this over subscription? What is this over subscription? See, over subscription means you received, okay, more, you receive more offer against what you have expected to receive. Now tell me. Yes, no. The provision you discuss, na, it is mainly because of the under subscription. Okay. Yes, we are doing for over subscription fully. We are going to learn the over subscription. It means what? We receive excess application which is over and above the normal issue you made. So whatever the issue you made, it is over and above the normal issue. It's actually called over subscription. It is actually called over subscription. Okay, let's move on to that. I think so, guys. You have written this, na? If you not, please make it. You guys written this, na? This one. Harsmita and Kruti, you have written this. Harsmita and Jivita, sorry, you have written this. Yeah, great, good. Take it. See, now let's move on to the over subscription. Now, in case of over subscription, what happened? We have issued 10,000, so we receive application for 20,000. So there are two ways to do that. Number one, either you can do the refund of excess 10,000 as per the previous example. So here, guys, what we are going to do, here we received here we have received 20,000 application against 10,000 shares we issued. So it means excess 10,000 we received. So we can do one thing, we can refund the excess 10,000 to the subscriber. It is one of the option. So excess 10,000 shares we can we can refund back to the subscriber. Otherwise guys, otherwise what we are going to do, we can adjust the excess money, you can say excess money on application against the allotment. It means the amount with respect to the excess 10,000 shares on application money. Let's say application money is 2 rupees. So the excess application money received 20,000 because your actual issue is 10,000, correct? So if your actual issue is 10,000, so your actual issue you have 10,000, correct? So non-actual application money is what, sir? If I take as a 2, 10,000 into 2 is 20,000. So actual issue is 10,000 shares. You can please mention 10,000 shares and it is a rupees, okay? 10,000 rupees. But you know how much you have received actually. So actually received how much money? Sir, we have received 20,000 into 2, that is actually 40,000 rupees. That we have actually received. Now see how much excess you received. Excess money we receive. How much excess money we receive, sir? We receive actually, sir, 20,000. Because 20,000 is normal application money that we need to receive. But actually we have received 40,000 rupees. So excess 20,000 we have received. So we can do one thing, we just adjust this 20,000 against the allotment money due. Whatever the allotment money due to be received in the next installment, we just make a set of this 20,000 against the allotment money. Let's for an example take allotment money due is 30,000. Allotment money is, you can say, due 10,000 shares originally into 3, so 30,000 guys, because 10,000 is the original issue, so you can multiply the 3 is 30,000, but we already received less, already received how much? 20,000. So if we receive already 20,000, then the pending amount to be received is 10,000. It is what? It is the money to be received. Money to be received for allotment. Money to be received for allotment, you can say. So what happened? If you receive over subscription and you doesn't want to refund it back to the public or the subscriber, rather you can utilize this money, okay, or adjust this money against your next issue, that is called allotment, against your next issue, that is called allotment. So that in case of allotment money due, the subscriber will have to pay less because they have already paid some excess money which was going to be adjusted against the allotment money, so they are going to pay less amount. So that is what the scenario. And when we adjust the excess application money with the allotment, this scenario is actually called pro rata. Pro rata allotment, you can say. Okay, this is actually called pro rata, means adjusting basis on the allotment, okay, adjustment basis on the allotment which we receive against the application. So it is what is called pro rata. So these are the separate part we are going to learn separately again, okay. This is two things when over subscription is going to happen. And alongside with this, in exam, sometime it's given mix of that. Mix of that means some money, some part refunded plus some part adjusted. So mixture of refund and pro rata. In the example, if I take 10 out of 10,000 excess shares, 5,000 refunded, 5,000 pro rata. So this also can become in the examination. So this is also a separate part to be discussed separately. So this is called the provision related to the over subscription. Now, I just wanted to get an idea how we are going to proceed with respect to the journal entries. So let's discuss the journal entries. You can write please guys. Journal entries. See, in case of the under subscription, full subscription, we already made the journals. But in case of over subscription, the normal journals are there. We understand the normal journals will be there. But other than the normal journals, we have to make some other entries in the books of accounts of the company. What are the other entries we need to make? See, at the time of, you can write this, at the time of application money due, at the time of application money due, okay, we can, please write, we can refund the excess money. So guys, when we make the entry, when you make the entry for the application due, that is equity share application account debit to equity share capital, at that point of time we are going to refund the excess application money so received. So journal entry will be equity share application account debit to bank account. Why bank is created? Because we are paying the money to the subscriber, so it is a cash outflow to me. So what goes out is created as per the real account. So that's why it's created. And equity share application is the amount that we receive. Now we are transferring or paying back to them. So when we are received, it's a part of capital, so it is credited. Now we are refunded back to subscriber, so it will debit it. That's all. So it is a logic of the journal entries. Why debit and why the credit? Now this is with respect to the refund entry. Now, for pro rata adjustment, in case of pro rata adjustment, what we are going to do? Same way we are going to make the adjustment, but the journal entry will be at the time of transferring into the capital, we make the same, we make the over subscription in the same journal entry itself, adjustment one. Equity share application account debit to, see, it is the due entry of the share application. So equity share should be credited. Equity share should be credited. It means equity share capital. And at the same time, also we can make the adjustment to the equity share allotment. We make an adjustment to the equity share allotment. So can we credit equity share allotment account? Equity share allotment. That is what the main journal entries we have done. So completed, sir. So equity share application account debit to equity share capital account to equity share allotment account. So it is the journal entry as required with respect to the pro rata. But see, the calculation is going to be a different one that we are going to learn. But it is a journal entry we need to follow wherever we are going to get any pro rata adjustment and any refund entry. Okay. So this is the over subscription part, guys. Now come to another part. Okay. As the most important thing is that as there is a total 4 part with respect to the share issue. Okay, like 4 part in the sense like 4 different installments with respect to the share issue, we need to understand that some investor may not able to pay, okay, the money, okay, at the time of to some investor may not pay the money at the time of, okay, like allotment, or at the time of first call, or at the time of final call. It's quite possible, correct? So that is what the first thing we need to remember. So sometimes some investor will not be able to repay, or sorry, to pay the money at the any installment part. So investors, you can write subscriber sometimes unable to pay the installment money due to any reason, due to any cause. So when a subscriber fail to pay the installment money due to be paid, and he fails so, then it is called calls, because all are the calls. These four are actually called nothing but these four. You can also say like it's an installment, or you can also say it's an call money. You can also say it's an calls are there. So see, these are the calls actually through which you are raising your capital. So calls, so calls in area you can write. Calls in area you can write. So when subscribers fail to repay the any installment, then the money is known to be as calls in area. Money is known to be as calls in area. We can try to first understand what is this account for. This is basically when investor fails to pay the money, pay the installment, then we need to make this entry. Okay, and it is a nature of, you can say, two way we can identify it. One, sir, you can say it's an asset to you because you are going to receive this money in the future. Maybe suppose someone not paid the money right now because they don't have the money to pay you, but it is quite possible this money you are going to receive in the future, so you can treat them as an asset. So you can debit this account because obviously you are going to receive the cash flow in the future. So obviously it's as per the comes in, what comes in debit. So you can debit this item, and sometimes someone may also feel it becomes a loss to company. Sometimes some accountant may decide that it's a loss to company, or some like uh, uh, account like who are the mainly in the maker of the standards and etc., they are going to focus, and the lawmaker also says someone it's a loss to the company, because once it's a calls in area, there's a very few possibilities that the company will receive this money. There's a very few possibilities that the company will receive this money, so it become a loss to you. It become a loss to you. So that is what important. It become a very much loss to you. Okay. So see, it's a loss to you. So you can also debit this as per the nominal account. So two ways we can think. It's a more logical because you are going to receive in the future. It is quite obvious today I am failed, but I am going to pay you in the future. So it's an asset to the company. So that's why it can debited. And also it's a quite logical that it's a loss to company because company may not receive it in the future. So company first book the loss in the calls in area. So both way can happen, but I am going to suggest you to follow this logic to incorporate the same. So calls in area is an asset which company may receive in the future. So it's a debit account. Okay. And now next. And the important thing is that as per the Companies Account 2013, sorry, Companies Act 2013, in preparing the books of accounts of the companies, calls in area, if there is a calls in area, okay, company can charge interest on calls in area at the rate of 10% if nothing is mentioned. So interest on calls in arrear may be charged at the rate 10% per annum. So if any amount is to be received from the subscriber or investor, then a company can charge 10% interest on that. Then the company will charge 10% interest on that. That is what the calls in arrear. Okay. Now next, it is a part, and next part is that, sir, suppose some of the investor are very good in their investment policies, so they can give advance money when, okay, they can give the advance money when they are paying the application or when they paying the allotment. It means the first call money that is going to be due after 2 months, one of the investor pays the money today as it is. So it means advance money with respect to the first call you will receive at the time of allotment. So it means advance money received, okay, advance money received for any subsequent call, for any subsequent calls. So when you are going to receive any advance money with respect to the subsequent calls, always remember one of the account is called calls in advance. The account is called calls in advance. Okay, and it is obviously, guys, if you receive in advance, if a company receive any advance money, it's a liability to the company. Am I clear? If a company receive any advance money, it's a liability to the company. So you can write it's a liability. It's a liability to company. It means definitely, sir, it should be credited. When company receive advance money, it should be credited. So it's a credit entry should be required. Okay. And see, if nothing says in the question and you have been asked to charge the interest on calls in advance, then the interest on calls in advance as per the statute is, interest on calls in advance as per the statute is, statute means law, at the rate 12% per annum. So interest on call 10%, interest on calls in advance is 12%, sir. So it's an asset to the company, it's a liability to the company. Okay, remember this. And we are going to make this journal. Okay, we are going to make this journal at the time of, we are going to make this journal at the time of like receiving the money. This journal we are going to make at the time of receiving the money. Both when you are going to receive the amount, we are making the calls in arrear entry at the same like combined entry, and when you are going to receive the calls in advance, then you are also going to make at the time of receiving the money from in the bank. So these two words very important here. One is the calls in advance and is the calls in arrear. Okay, so this is like overview of the company accounts, and other than this, two more part we need to discuss in a separate way, like share forfeiture is there and reissue parts is there along with the pro rata. So guys, this is what about the first part of the issue of shares. Thank you guys. Thanks a lot.